The market is climbing a wall of worry. We have strong momentum running straight into major macro risks. Here's how to think about positioning for the next 1 to 2 weeks. All right, here's our game plan. We'll start with the market's core conflict. Then we'll quantify the 2 biggest risks. After that, we'll map out the key levels using options data and then build a strategic framework with specific trade ideas. So let's start with the big picture. The central theme right now is this powerful trend running into some measurable, fundamental cracks. This is the classic definition of a market climbing a wall of worry. This slide really just lays it all out, the core conflict we're dealing with. On one hand, you've got this incredibly bullish price action. 7 straight up months, an 85% earnings beat rate, positive seasonality, and $7 trillion in cash sitting on the sidelines. But on the other hand, you can't ignore the headwinds. We're on day 35 of a record government shutdown, and the VIX is stubbornly holding near 17, which tells you there is still real fear out there. Okay, let's dig into that first major risk, the government shutdown. Look, this has gone way beyond a political headline. It's now having a real, measurable impact on the economy. And this is not some abstract problem. The FAA is reporting over 400 flight delays every single day because of federal worker shortages. That is a direct hit to our country's economic infrastructure. The economic cost is serious. The Congressional Budget Office estimates the damage is in the tens of billions nationwide. That's a direct drag on GDP, plain and simple, from workers not getting paid and services being disrupted. Now for the second risk. This one is a little less visible, but it could be even more dangerous. We're seeing signs of stress in the financial system's plumbing. So, to get this, you need to know what the overnight repo facility is. Just think of it as the Fed's emergency cash window for banks. When you see a huge spike in its use, it's a clear signal that banks are scrambling for liquidity. It's an important warning sign. And that is exactly what we saw, a sudden $50 billion surge in that facility. Now, according to analysis from FX Evolution, this isn't just noise. This is a clear warning sign that banks are facing funding stress under the surface. And that's a problem that can spread quickly if it's not contained. Okay, so we've defined the risks. Now let's map out the battlefield. The options market gives us a quantitative look at the key levels where the big players, the dealers, are positioned. For the S&P 500, we're looking at what's called gamma exposure, or GEX. In simple terms, this shows us where options dealers have to buy or sell stock to hedge their books. And right now, the data is creating a massive support floor right at 6850. If we break that, selling could pick up speed. Then, above us, the 7,000 strike is acting like a giant magnet for price heading into the end of the year. Here are the other critical levels to watch. For the QQQ, $630 is the line in the sand. A break there opens up the downside, especially when you factor in its negative seasonality right now. And for the VIX, if it makes a sustained move above 20, that tells you fear is taking over and the bear case is officially in play. This content is for educational purposes only. It's aggregated analysis from multiple public sources to help you stay informed and improve your own decision-making. Do your own research. This is not financial advice. All right, now let's translate all this data into a strategic framework. Remember, this is about planning for probabilities, not predicting the future. Our base case, which we're giving a 60% probability, is that the market just stays range-bound, chopping between those key gamma levels of 6850 and 7000. The bull case is triggered by a quick resolution to the shutdown, pushing us through 7,000. And the bear case? That's an escalation of those liquidity fears, which would be confirmed by a break of QQQ 630 and a VIX spike over 20. So the bull thesis is pretty straightforward. The market just keeps climbing that wall of worry. That $7 trillion in cash on the sidelines is the fuel, and a shutdown resolution could be the spark that triggers a sharp rally right to that 7,000 gamma target. This whole thesis is invalidated on a decisive break below 6,800. Now, the bear thesis focuses on that repo spike being a real warning signal. If those liquidity fears build and you combine them with the shutdown's economic drag, it could easily break the QQQ's critical 630 support and trigger a wave of selling. This thesis is off the table if QQQ can reclaim 640 with conviction. Okay, let's look at a couple of actionable risk-defined trade setups to illustrate these ideas. Again, remember, this is all for educational purposes. First up, a bearish idea tied directly to that shutdown drag. The JETS airline ETF is obviously exposed to the flight delays we talked about. The thesis is simple. The pressure on these stocks continues as long as the shutdown stays unresolved. A put-debit spread is a clean way to play this. For example, buying the December 20 put and selling the 18 put against it. This gives you that directional downside exposure, but with a defined capped risk, which is just the debit you paid to enter the trade. The exit plan is also simple. If a shutdown resolution is announced, the thesis is busted. And since this is a news-driven trade, it's probably smart to start with a smaller position size. Second, a more cautious stance on tech, mainly because of that conflicting seasonality signal. The thesis here isn't calling for a crash, it's just that near-term upside for the QQQ looks pretty capped. A call credit spread can express this cautious view really well. For instance, selling the 3-week 640 call and then buying the 645 call for protection. This strategy makes money from time decay, or theta, as long as the price stays below your short strike of 640. Your max loss is defined from the start, and you know your invalidation point is a decisive close above that 640 level. Not trading advice, just a market update to keep you informed. Markets carry risk, trade your plan, manage downside, and verify all data. So we have a classic standoff. You've got powerful bullish momentum running headfirst into significant macro risks. The key question for the next couple of weeks is simply this: which force will win? Keep a very close eye on the levels we discussed, SPX 6350 and 7000, and that critical 630 level on the QQQ. Be ready to act.